Yo, it's Midas. Let's talk about what are the main events you should know as an investor. This is what actually moves the markets. So disclaimer, everything said in this video is only for educational purposes. Make sure to always do your own research. This is why you listen to me, Midas, while I beat the S&P 500 by 103x in less than a year. If you want the proof, you can check it out in my link in bio. It'll show you the date of my calls, the tickers I called, where the call was posted, whether it was YouTube or TikTok, and my total gains, which is worth 5,000%. So let's get to the video. So the concept of just buy and hold, bro, is wrong. Everyone says just invest and hold, but if you don't know what actually moves the markets, you'll always be late. These are the real events that Wall Street watches. So the first event is the FOMC meetings, the Federal Reserve decisions. We had them recently, a lot of people were anticipating it, and basically if, Powell decided to cut rate or not cut rates, what determined if the market would have pumped or dumped. He cut rates, so that meant that the markets went up. However, if he held or just, raised the rates, that would have obviously dumped the markets. But these interest rate hikes are borrowing costs rise, business and consumers slow spending because it costs more to, you know, borrow money. But the rate cuts mean that it's cheaper to borrow money, so more liquidity. Stocks often pump in the short term, but may signal weakness. And the Fed's, dot plot and Powell's words move markets more than the decision itself. That's you see all those memes on traders, trying to trade off of what Powell says, and the market usually just goes down when he says good afternoon. It's just the meme is correct. Everything that what Powell says as he leads the Federal Reserve caused the market to move. Another event is the CPI and inflation reports. CPI shows how fast everyday prices are rising. It's a direct input for Fed policy. Hotter than expected CPI equaled fear of more hikes, equal bearish for stocks. And a lower CPI equals markets rally as investors price in future cuts. Another event is job data with NFP, unemployment rate for non-farm payrolls, first Friday each month, faster read on labor health. With strong jobs equal good economy, but higher for longer rates slash mixed signal. While weak job reports spark recession fears but forces Fed closer to cutting. That's exactly what happened with recently in December with the recent Fed cut was because of weak job reports. That's why they cut the rates. Another big thing is the corporate earning season. So mainly big tech earnings like Apple, Microsoft, NVIDIA, Amazon, Tesla, Google drives the S&P and Nasdaq. They're called the Mag 7 for a reason. And if earnings beat bullish rallies, you can see this with NVIDIA. If they have good earnings report, usually the market is green the next day. However, if they miss, it's a massive sell-off, especially for NVIDIA, who's the apex, AI company out there. If their sales of GPUs are slowing down, that means the AI market is going down. So therefore, that's bad for AI in general. While forward guidance often matters more than actual results. For GDP, growth data, also important. Quarter GDP headlined number for economy strength. Whereas strong GDP is bullish if inflation is under control, while weak GDP is slowdown, bearish, and can trigger recession narratives. This is a huge one with geopolitical events. This is why people bet that there's going to be a recession coming with the wars, the sanctions, energy stocks, supply chain risks, and volatility are always involved. US elections, if Trump or Camilla got elected, that would have shifted how the market sentiment would have been with policy changes on taxes, regulations, stimulus checks, with COVID-19, global crises like, China slowdown, oil spikes ripple into US markets. All of these things affect how the stock market perceives if we're going to go higher or if we're going to go lower. Are we going to reach recession or are we going to keep going to the moon? Another one is bond market and treasury yields. Bond rising yields make bonds more attractive than stocks. So stocks fall. Yield curve inversion. Historic recession warning sign. The 10-year treasury is the gravity of global asset pricing. Another one is global central banks like the ECB, BOJ, and PBOC decisions ripple into US markets via currencies. So global liquidity drives risk on versus risk off, carry trades, dollar strength. That's why you can see, the yen going down or the euro going down. That can affect the US markets, which would affect the US stocks and therefore the whole NASDAQ. But sometimes foreign central banks ease while the Fed tightens, equal global imbalance. But you have any questions about any of what I said about these, different events? Give me a comment below and respond when I can. I'm also launching exclusive Discord, so if you want real-time stock and crypto calls, access to my full portfolio, become financially free, and join the community of hungry degens, join in my link in bio. If you want access to all my stock picks, you can check it out in my link in bio. And if you enjoyed the video, subscribe and like for more. That's all I got for today. I will catch you guys in the next video. Peace.